I want to share why I've moved away from bond funds for the conservative portion of my clients' portfolios and what I'm using instead. This isn't about chasing higher returns. It's about getting better risk-adjusted outcomes, more predictable income, and actual downside protection. In today's video, I'm going to walk you through the bond replacement strategy, why bond mutual funds have structural problems that most investors don't understand, and how fixed index annuities work as an alternative and when this approach makes sense for your portfolio. Chapter 1, the bond fund problem. No maturity date, no guarantees. Let's start with the fundamental issue. Bond mutual funds and bond ETFs are not the same as owning individual bonds, and that difference matters enormously for retirees. When you buy an individual bond, let's say a 10-year treasury, you know exactly what you're getting. You have a fixed coupon payment schedule, and if you hold that bond to maturity, you get your principal back at par value as long as the company still exists. Yes, the bond's price will fluctuate if interest rates move, but if you simply hold it, those fluctuations don't matter. You have a maturity date that anchors your return. Bond funds work completely differently. A bond mutual fund or ETF is a pool of hundreds or thousands of bonds that are constantly being bought, sold, and rolled over. The fund never matures. This creates three major problems. First, you have perpetual interest rate risk. When rates rise, bond prices fall and your fund's net asset value drops. With an individual bond, that's temporary. You can hold it to maturity. With a bond fund, there is no maturity to hold to, so you're permanently exposed to rate movements. Second, you have no principal guarantee. If you need to sell your bond fund shares when they're down, maybe because you need income during a rate spike period, you lock in a real loss. The SEC explicitly warns that bond fund investors can lose principal even when none of the underlying bonds have defaulted. Third, bond funds generate unpredictable income. Individual bonds pay a fixed coupon. Bond funds pay distributions that vary month to month based on what the manager is buying and selling, what's maturing, and what rates are doing. If you're a retiree trying to budget, that variability is a planning headache. Let's look at a bond fund returning 7%. Those are respectable numbers. When you subtract ongoing expense ratios, which range from 0.04 for low-cost funds to 1% or higher for active funds, and factor in the psychological cost of watching your money swing during volatile periods, most investors are not getting the stability they think they're paying for. Chapter 2, how fixed index annuities work, the bond alternative. So what's the alternative? For the conservative bond replacement portion of a retirement portfolio, I often use fixed index annuities or FIAs. A fixed index annuity is an insurance contract. You give the insurance company a lump sum, let's say $200,000, and in return, the insurer guarantees that your principal will never go below zero due to market losses. That's the floor. Your money then gets credited based on the performance of a market index, typically like the S&P 500, subject to a cap or a participation rate. Historically, FIAs have averaged somewhere in the 5 to 7% range over full surrender periods, with the potential for higher years when the markets are strong. That's not going to beat an all-equity portfolio over 30 years, but it consistently beats the 1 to 2% real returns many bond funds delivered during the 2010s low rate area, and it does so with a principal guarantee that bond funds simply can't offer. The trade-off? Liquidity. Most FIAs have surrender periods of 7 to 10 years. If you withdraw more than the penalty-free amount during that period, you'll pay surrender charges that start around 7 to 10% in year one and decline to zero by the end of the term. But if you're using this money as the conservative bond replacement bucket in a retirement portfolio, money you don't plan to touch for 7 to 10 years anyway, those liquidity restrictions are not a bug, they're a feature. They enforce the discipline that this money is not for emergencies, it's for the intermediate term safety and income bucket of your plan. Chapter 3, addressing the annuity objection. Yes, they pay commission. Let's talk about the elephant in the room. Annuities pay a commission, and a lot of people have been told that that means they're bad. It's true. Fixed index annuities typically pay the agent or the advisor an upfront commission. For example, a $100,000 FIA might pay the advisor $4,000 to $6,000 in total commissions over a 1 to 5 year period. That commission is built into the product. The client still gets the full $100,000 credited to their account value, but the insurance company pays the advisors out of their profit margin. Compare that to a bond portfolio managed under an advisory fee model charging 1%. On a $100,000 bond allocation, that's $1,000 every single year forever. Over 10 years, $10,000 in fees, and it comes directly out of the client's account. So yes, the annuity pays a commission, but the bond portfolio charges an ongoing fee that over a similar time horizon can be comparable or even higher, and it's deducted from your returns. What matters is transparency. Clients should know how their advisor is paid, whether it's commission or fee. And they should understand the surrender schedule, the caps, the riders, and all the trade-offs. Chapter 4, when bond alternatives make sense and what else is out there. Fixed index annuities are not the only bond alternative, and they're not right for everyone. Let's talk about when they make sense and what other options you might have. When FIAs make sense. Well, First, you're in or near retirement and you need a conservative allocation for the protected income bucket of your portfolio. Second, maybe you want downside protection. You can't afford to see this portion of your portfolio drop 10 to 20% in a bond bear market. Third, you're comfortable with the 7 to 10 year surrender period because the money's earmarked for future income, not for emergencies. Fourth, you have other liquid assets, cash, short-term CDs, money market funds to cover at least 1 to 2 years of expenses when FIAs don't make sense. One, you need full liquidity and flexibility. If you might need to access more than 10% of this money in any given year during the surrender period, a FIA may be too restrictive. Two, you're young and building wealth. FIAs are designed for retirement income, not for long-term wealth accumulation. Three, you're already heavily annuitized through pensions or other guaranteed income and don't need more insurance-based guarantees. What about some other bond alternatives? If an FIA isn't the right fit, here are other options for the conservative bucket. First, CDs or certificates of deposit. CDs are FDIC insured, have fixed terms, and are more liquid than annuities. The downside, lower return potential than an FIA in a strong market year, and you're still exposed to reinvestment risk when the CD matures. Second, money market funds. These generally earn 10 times what you'll get from many standard savings accounts, both of which generally track the federal funds rate. They're highly liquid, low risk, and great for the short-term bucket, but they offer no real upside participation. Third, bond ladders. If you have a large enough portfolio, you can build a ladder of individual bonds with staggered maturities. This gives you the predictability and maturity dates that bond funds lack, and you avoid ongoing management fees. The downside is complexity and the need for sufficient capital to diversify across multiple bonds. Fourth, MYGAs or multi-year guaranteed annuities. These are like CDs issued by insurance companies and often get higher returns than comparable CDs. They're simpler than FIAs because they have no index crediting, just a fixed rate, but they still have surrender periods. The right choice depends on your time horizon, liquidity needs, risk tolerance, and overall portfolio structure. Chapter 5. The bottom line, is this strategy right for you? So let's bring this all together. Traditional bond mutual funds and ETFs serve their purpose for decades, but the structural flaws with no maturity date, volatility, unpredictable income, and ongoing fees make them less and less attractive today, especially for retirees who need certainty and downside protection. Fixed index annuities offer an alternative, a zero loss floor, competitive growth potential averaging 5 to 7%, with upside caps near 10 to 11% in strong years, and the discipline of surrender period that aligns with the intermediate bucket of a retirement plan. Yes, they pay a commission, but when you compare that to the cumulative fees of an advisory account over 10 years, the math is not as one-sided as critics claim. Other alternatives, CDs, money market funds, bond ladders, MYGAs, each have a place depending on your liquidity needs, portfolio size, and your risk tolerance. The key is to think in buckets. Your short-term money, years 0 to 2, needs to be fully liquid and safe. Your intermediate term, years 3 to 10, should prioritize principal protection with moderate growth. This is where FIAs, CDs, and bond ladders shine. Your long-term money, focused on growth and stocks because you won't need it for more than a decade or more. If you're sitting in a traditional 60-40 portfolio and wondering whether there's a better way to structure that 40%, the bond replacement strategy is worth a serious look. If you found this helpful and you'd like to learn more about how we help clients implement strategies like this, click on the link in the description to schedule a complimentary consultation with our team. Let's build a retirement plan that's designed around your life, not just a one-size-fits-all allocation.